Good afternoon, everybody. My name is Tim Devlin. I'm one of the financial planners here at Life Pro Asset Management. I'd like to welcome you to this week's episode of our weekly update. I will be filling in for Robert Rayburn this week. He's out sick and has actually lost his voice. So this week, I'd like to take a more financial plan approach to this weekly update, really focusing on how we can navigate market drawdowns and how your financial plan will help guide you through those tumultuous times. And so the first thing that we always want to make sure is that we have a plan in place. We don't want to go into these situations blind with nothing to lean on. Market drawdowns, they have a way of highlighting that need for a plan. Whenever the market can go down 10, 20% like it has over the past few months, well, we need something to lean on. Otherwise, we start relying on our emotions and make potentially irrational decisions. And so we need a plan first and foremost. And specifically with that plan, we want to focus on what you have control over, what you can directly influence. And we'll get into that a little bit more in just a moment. Second, once we have a plan, we need to follow that plan. We need to make sure that we're focused on your long-term goals and always ask ourselves, will these short-term effects or short-term events that have happened affect your long-term plan and your ability to reach those goals? That's the second thing. And then finally, once we have a plan, as we're following that plan, we want to utilize that swing coach or financial advisor. They're going to help you both stick to the plan and potentially improve the plan if needed. If things have changed in your life, we want to reassess things. We want to make sure that we have the ability to change things if needed based on those time horizons you have. And so first, let's focus on what you do have control over, because there's a lot of variables in retirement and as leading up to retirement. And so a couple of things that you have total control on are savings and spending and your asset allocation and location. So in other words, how much of stocks versus bonds and where those are located. So things like a tax deferred account versus a taxable account. So those are things that you directly can control. Some things that you have a little bit of influence on are things like your employment earnings, how much you earn at work, the job that you work, and that duration until retirement or until you stop working. Also, longevity, how long we expect to live. I hope we all have healthy, long lives. But this is an example of something you control. You eat better, live a little bit longer. These are examples of things that you have influence over. Now, things that are totally out of your control are market returns. You don't have the ability to influence what the S&P 500 does over the next few days, right? We know that, but we can look historically and put ourselves in a good position going forward based on what's previously happened. So this is an example of something that's out of our control, and we really need to focus on things that are in our control. And so as it relates to things that are in control, we want to focus on the plan and the strategy that we have in place. And so we as a firm believe in what's called time-focused asset allocation. And really what we're trying to do is, first and foremost, figure out what those goals that you have are. Once we do that, we need to figure out how far in the future they're set to occur. So that can be a goal like something like a home renovation, a car purchase. It could happen over a very short term. Right? It can be just a year from now, 2 years from now. And vice versa, we could have something that's very long-term, something like retirement planning. Maybe you have 5, 10, 15 years to retirement. We want to have a little bit different strategy for those longer-term goals. And so one of the things that we like to do with clients is give every dollar in their state an objective. And so you'll see here on the screen, we have 3 different buckets, and below that, different time horizons. First and foremost, we need an emergency bucket. We want to make sure that you have cash on hand for unplanned expenses, those emergency needs that you have in life, really for things over the next 0 to 1 years, right? We don't want to take a lot of risk. We can go through periods like we have over the past few months, and to no fault of your own, you may be forced to lock in losses. We want to try to avoid that to the best of our ability. Second, we might have short-term goals. We may have things that are set to occur over, call it the next 1 to 4 years. For that, we want to earn some rate of return. That's a long time to have your money sitting in cash, but we don't want to take too much risk. there's still a chance that the market can go through a drawdown period, and we want to eliminate the risk of large market losses. So for this, we want to take a more conservative approach with the investments in your portfolio. Now, once we do those first two things, that's where we can identify this long-term growth bucket, really try to grow the value of your estate. And if we set this up correctly, the month-to-month events over the short term won't impact your long-term goals in the grand scheme of things, because you have these layers of defense prior to ever getting to them. You won't have to tap into this long-term bucket and lock in losses because you have this emergency bucket set up first. You have this short-term, less volatile bucket set up. So that's how we want to focus on our strategy, and it'll help us navigate these drawdowns. Now, speaking of drawdowns, they're quite common. You can see here on this chart, these are examples of all of the declines in the S&P 500 greater than 10%, which classifies as a drawdown. And what you'll also see is how long it's taken throughout history to recover money. And so that's an important aspect. History suggests markets do recover. And so we believe that to be the case going forward as well. One thing you'll notice, though, is over the past decade, we've had the benefit of very short-term drawdowns. In other words, we've been able to recover those losses in just about 120, that's about 3 months, 146 days, 150, 193, so on, right? So really, we're talking about anywhere from a 4 to 6 or 7 month period where we could recover our money. We haven't experienced something like 2008 in a long time, but 2008 provides a great example of that time horizon. If you look at the recovery here from that 10% decline to recovery, roughly 4.5 years later, you broke even on your money. And that's an important concept. If we can have that longer term time horizon, the short term won't matter as much. But this drawdown has been particularly painful, and it hasn't necessarily been reflected in the index. And so what I'd like to go through is this chart here. And so it says at the top, most stocks are down a lot. And so over the past few months, we've seen underneath the index, a lot of stocks are experiencing damage. Now, the index itself hasn't necessarily reflected that, but what you can see here is on the top half of this chart, we have the NASDAQ composite, one of the major indexes. And we have the price level of that index over time. Below that, on this bottom half of the chart, we can see the percentage of the stocks within the index that are down 50%, down 75%, and down 90% within the index over time. So, for example, right now, we see the index has pulled back a little bit, around 20%, plus or minus a few percent at this point, is what the NASDAQ's off. But underneath the hood, we can see almost 50% of the stocks within the index are down more than 50%. Over 20% are down more than 75%. So underneath the hood of the index, we're experiencing a lot of damage. And so I think that's what's made this particular sell-off more painful than others, and maybe hasn't necessarily been reflected in the index than most investors will look at. So the question is, okay, a lot of stocks are experiencing damage. So what do we do next, right? How do we manage this? Well, one of the things that we always say is if we have that long-term time horizon, we want to stay invested. We don't want to panic, let our emotions take over, and move to cash. And so this chart does a great example of this, because you'll see at the top here, market timing can be costly. And what the chart shows is the annualized performance of the S&P 500 index from 1990 to 2021. And what they're showing is if you were fully invested during that time period, you had an annualized return of 9.9%. But if you just missed the one best day within each year, your return dropped 3.8%. You only received a 6.1% annualized return. And you can see as you start missing those best days, your return suffers as a result. And If we moved to cash and we did not participate in the rally, and that was one of those best days, this could be the end result. In long term, this has a very detrimental effect on your ability to reach your goals. There's a very large difference between earning 9.9% per year and missing the best 10 days each year and only receiving a negative 12.6%. So earning a loss during that time period. And this time frame goes through bear markets, right? We're through the 2000 period, the 2008, the COVID crash. Everything is included in there, and it just speaks volumes to the importance of staying invested. So we want to stay invested if possible, but then the question begins to rise, well, when should I reallocate? And so we always recommend reallocating from a position of strength when possible, but we always want to ask ourselves a few questions. And the first is, what is my time horizon? How long do I have for this money? And has it changed? If originally I had a 10-year time horizon, but now I might need the money in 6 months, that changes things a lot. We may not have the ability to recover. And so we want to make sure that we're addressing that need. 2, do you have planned expenses over the next 6 to 12 months? Similar to what we just talked about, do we have cash set aside for these expenses, or are we going to have to tap into this money? If we're tapping into this money, we want to assess, maybe we need to make some reallocation. And then the third thing is, how will you react if stocks fall farther? We want to make sure that we're not making emotional decisions. And this is really where your advisor will help you. They're your financial coach. They're going to help you through the process and navigate, when should I be reallocating? What's the proper time? And what's the best way to navigate this market? Your advisor combined with your plan are going to be your lifesavers through periods like this. So just to summarize quickly what we've talked about, we want to focus on your long-term plan and lean on your advisor during these difficult times. More than anything, we want to make sure that we have a plan. But once you do, stick to your plan. Make sure that you're following what you initially set up. Focus on what you have control over and what you can influence, and don't worry so much about the things you have no control over. If you have a good plan in place, good time horizon set up, we're pretty confident that we can have a good outcome over a long time horizon. And so with the last thing I'll say is lean on your advisor. I really encourage you all, if you do have questions as it relates to the recent market volatility, if you should be reallocating, please reach out to your advisor. They're here to help you. With that, I want to thank you all for joining me this week. And next week, Robert Rayburn will be back on for our weekly scheduled programming. And with that, I say thank you.